Goldman Sachs is also known to manage money for some of the world's most wealthy individuals. So maybe we start by anchoring the discussion on who your clients really are and what they're looking for.
Sure. So Goldman Sachs has been around for more than 150 years, and we have been in private wealth management since the 1950s. We're very focused on helping our individual clients reach their wealth objectives so that they can maximize the impact possible with their wealth. The way that our clients experience the firm is through our advisors. Our advisors have been with the firm on average a very long time, and this allows them to get really deep with their clients and really understand their values, their objectives, and really customize their risk tolerances and portfolios in a way that they can make it through various life events, various life market cycles, and really optimize for that. The other thing that we do at Goldman is we really surround our advisors with areas that are unique for ultra high net worth clients. And these tend to be areas like optimizing your asset allocation, how to deal with concentrated single stock, tax planning. And our advisors really curate the firm and this sort of content to be able to deliver that to our clients.
Meena, when you talk about wealth, what does it really mean? How much wealth does a typical Goldman Sachs private wealth client have?
Sure. So one of the things that David Solomon and John Waldron did about a year and a half ago is they reorganized Goldman Sachs. And one of the things they did is they created a consumer and wealth management business. And so what we do within CWM is that we work with all levels of wealth across the organization. And we really help people optimize their wealth based on the investment offerings that are relevant for them to be able to do that. And so any level of wealth, we would love the opportunity to be able to work with clients. Within private wealth management, we work with ultra high net worth individuals. And these individuals do have opportunities to invest in offerings that are more institutional in nature. And those tend to be more illiquid, which tend to be more on the alternative side.
Well, we're going to talk about alternatives in a second, a hot topic kind of in this inflationary environment. But when we think about the risks that are mounting in the world, there's a war in Ukraine, there's inflationary pressures. What are your clients most worried about?
I would say our clients, they're very focused on two things, if you think about their objectives: wealth preservation and wealth growth, capital growth. What prevents that from happening? Permanent loss prevents that from happening. How do you get permanent loss? Taxes, inflation, concentrated single stocks that go poorly, leverage and being a forced seller at the wrong time, so not having the right asset allocation, and nationalization of assets. We have a global private wealth management business, and so based on the region that you're in, that means a lot of different things based on that region, and we're working with our clients to help.
Well, let's break some of those things down a little bit. Let's start with inflation. How are clients pivoting their portfolios in relation to inflation, especially because you have said so many are hoarding cash?
Yep. So let's just talk, what do we think about inflation right now? In the US, we do think that inflation's peaking right about now. And we expect that it's probably going to go down to a little less than 4% by the end of the year. And that's because you're getting supply chains that we expect to moderate. You are going to get rate increases, which are really well televised yesterday, and you'll get the runoff of the Fed's balance sheet. The other thing that's also sometimes overlooked is really the fiscal stimulus that we had last year. That's not going to be the same this year. So that combination of things is why we think that inflation probably ends up around 3.9% by the end of the year and even lower next year. What do you do to protect against high inflationary environments? Asset classes that tend to perform well: equities, alternative assets, real estate. And so within equities, we're recommending that our clients have exposure to names that have pricing power, that have high margins, that have strong profitability. You think about what's really gone on in the marketplace over the last year, and you've seen, or really the last 6 months, you've seen the names that where previously were really valued highly on future growth potential being really the stars. Now what clients are very focused on is profitability. So the underlying profitability. What sectors do we think that comes in? Healthcare, energy, and disruptive tech that's profitable. If you look on the credit side, what we would recommend is focusing in on private credit opportunities where you have floating rate exposure. So that floating rate will reset as you get increase in interest rates. And then lastly, on the alternative side, there's a number of things, but real estate, you'll get rent resets as inflation goes up.
So there's two conflicting things here. One, a focus on value, if we're going to use market parlance, value versus growth, this worry about growth, but also somehow a focus on disruptive technology. So how then do your clients, because they have the opportunity to invest in venture, do they feel about venture capital?
Sure. So taking a step back on alternative investments, ultra high net worth individuals, as I mentioned before, have the opportunity to invest in alternatives. And we very much think that is an asset class to embrace for them. And we've been doing that since the 90s. And I say that because we worked with our clients through multiple market cycles during that time period. And the thing that's proven to be successful and profitable for them is staying the course with vintaging. So coming up with a plan of how much money you want to put to work every year and continue to put that money to work, because it's impossible to time the markets, and it's also impossible to, to figure out what underlying strategy is going to outperform at any given time. And so we've seen no decrease in our clients' commitments to alternatives, and nor are we recommending one. If you look under the hood as it relates to alternatives and what we see people doing right now, whether that's family offices that are investing directly or whether that's our managers, there is a discrepancy between private market valuations and public market valuations. Public market valuations are at a discount to private market valuations. What does that mean? You have crossover managers that are right now spending more of their time investing in public markets. And given that you had a relatively quiet IPO and follow-on market, we're probably going to see more pipes in the public markets where managers will be able to take advantage of. On the private side, what we're seeing is that because you've not seen equilibrium be reached between where companies want to raise capital and where investors want to invest, they're doing non-equity setting deals. So raising capital in a way that does not cause them to reset their equity valuations. Things like fixed discount converts. So very focused on structure. We do think that this equilibrium is going to be met over the next couple of quarters. But whether it's venture, whether it's buyout, it is very much about staying the course, because you have to focus on the top managers. You cannot invest indiscriminately. And what we look for when we look for managers is who has a sourcing edge, who has sector expertise, and who has real operating experience. And it's right now, whether it's a venture capital firm or whether it's a late stage company, where that operating expertise is really going to come into play, because you have to be able to work with the cash that you have to be able to continue to transform your company.
By the way, this is going to be a huge theme throughout the entire day, but I also want to take a big step back here and look globally.
Sure.
So some news about Goldman Sachs. They were the first bank to announce an exit from Russia. They also were among the first to say that they would be moving staff from Russia to Dubai. You manage a global business. Mm-hmm. So when you look at what's happening around the world, in Russia, in the Middle East, in China, mm-hmm. how is that making you think about how you address the global client in this era of geopolitical uncertainties?
Sure. So, yeah, very proud of our organization that we were the first to retreat from Russia and bring our people out of Russia to the extent that they wanted to, and we are winding down our business operations in Russia. We do have the good fortune of running a global business, and as I mentioned before, the concerns that people have in each one of those regions are different. It could be sanctions, it could be nationalizations of assets, it could be concerns of common prosperity. And you've seen that in all of the regions that you just mentioned. And the thing that we really focus on is having a diversified portfolio, and that doesn't just mean investing in your own country. You really have to diversify outside of your country when you're in those locations.
So you mentioned common prosperity. When you look at China, is common prosperity going to be a net positive or a negative for Goldman Sachs?
I think common prosperity will increase wealth levels across the spectrum. And when you increase wealth levels across the spectrum, what you get is you should get more spending, especially from the bottom, those that are with the least amount of wealth. And that increased spending will spur GDP. Increase in GDP is good for Goldman Sachs.
So there's things to be learned from what is happening in China over here in the US. You have common prosperity in China, but back in the US you have President Biden's tax plan. When you were talking to your clients, what are they most concerned about in terms of how that might impact their wealth and the investments they might make moving forward because of it?
Sure. Last year, we definitely saw a lot more activity in terms of estate planning being set up, which actually didn't come into fruition. This year, right now, we are not seeing as much concerns or actions around Biden's recent budget proposal. What that proposal did suggest is that there's going to be more focus on deficit reduction than on fiscal stimulus, and that's given where inflation levels are, and that they really want to accomplish a few policy goals, such as renewable energy, and they may increase taxes to pay for that. And so where might that come from? It could come from the corporate side and or the individual side. And so if it's on the individual side, it could be a surtax. It could be including private businesses and the net investment income tax. So there's a number of ways, and regardless of what it is, we're going to help our clients think, really strategically about how to invest.
One thing you had mentioned to me previously was that it's not just about corporations being taxed, it's about the executives as well. How far do you think that goes? And do you think that this can really reach a wide set of corporate America and people who are at different levels of management here?
Sure. So I think what you're referencing is in Biden's budget proposal, there was a recommendation of a 1% tax on buybacks. And buybacks have been the most significant net buyer, corporate buybacks have been the most significant buyer of equity markets over the last several years, and we actually expect that to be $1 trillion this year. And so to the extent that there is anything that happens on the corporate tax side for buybacks, we do anticipate that's probably going to lead to more volatility in the equity markets. The other thing alongside that 1% tax that was suggested is elongating the time period by which corporate executives would be able to sell their stakes. And so if you're doing a buyback, they don't want you to sell your stake at the same time. The thing is that we don't know how broad that goes, right? Corporate executives, you can go very deep into an organization. And the thing is, what's really good for these executives is being able to diversify their wealth. It's one of the things that I said could create permanent loss is, having concentrated wealth. But to offset the concern that, is out there as it relates to, potential timing of the market, I really think the SEC is being thoughtful as it relates to increasing transparency around it. So increasing transparency around the 10b5-1 plans that corporate executives have set up as it relates to when they're selling, the price they're selling, the number of shares, et cetera. So my sense is that there's going to be more focus on that side of it.
I want to shift to another topic here because a lot of us have probably spent a lot of time in Florida lately, where a lot of people from New York have been moving. There's been a lot of business conferences, and you held one recently. But there's been a lot of talk about the disparity in corporate America of women rising to the top. You see it very, very differently from where you sit. Can you explain kind of the demographic you're seeing, the rise in women in wealth, and how that might be fueling your business?
Sure. So maybe just to put some statistics to that in terms of the demographic shifts. There's three things that are going on. The baby boomers are aging and passing. What tends to happen is that first transition goes from the male spouse to the female spouse. And that's because women outlive men by 5 years and tend to marry 2 years older. The second thing is there's a number of women who are making financial decisions and managing their money for the households has increased about 30% over the last 5 years. And then you also have more women coming into money. So those are the demographics that is unfolding, and it's not lost on the wealth management industry. We started seeing that firsthand in our business in terms of the number of female clients that we've had the opportunity to work with. And so we created a platform internally in the firm, and we just recently launched it, called In the Lead. And it's geared towards our private wealth management female clients as it relates to content, advice, and community. And just to bring that to the next level, this summit that you suggested that we have, we brought 100 leading women at heights of various aspects of their fields, philanthropists, corporate executives, family founders, those who represent the next generation of their wealth together. And we covered topics that were very timely, things like cybersecurity, NFTs, investing, the geopolitical landscape, and that was very interesting. But the thing that was electrifying was actually getting this group of women together and having them feed off of each other in terms of ideas and experiences. And you know, some of the themes that came out of that, for example, that I found very interesting, but again, not surprising because we're seeing it. These women feel very fortunate, and they want to pay that good fortune forward. And what does that mean? They want to invest and give along common values. That common value that tends to be very significant that they're focused on is equality. So yes, climate change, but also very much equality. The other thing is that they want to prepare the next generation for wealth. And that doesn't just mean from a financial perspective, but that means from living with purpose and having a meaningful life outside of wealth. And then, we did have quite a few corporate executives who are running multi-generational families at the summit with us. And one of the things that really stood out is being known by your first name, not by your last name.
You mentioned equality, and this is a time where over the last couple of years, the stock market has risen, housing prices have risen, and the wealthy have gotten wealthier, but those without wealth have been left behind. How much of that focus on equality is a result of that?
I think people are very attuned. Our clients, all of our clients, are very attuned to the wealth inequality globally. And that is why we are seeing so much more focus on not just giving to areas that will help that inequality, but also investing in areas that will help with that inequality. And by the way, that does not mean expecting subpar returns. You're probably going to get better returns by following some of these investing strategies.
So another thing that you had mentioned was that these women were interested in NFTs. I think crypto is something that's on a lot of people's minds. In fact, when we polled our audience on which asset class will perform best this year, 44% of our audience said it would be cryptos, even more than commodities, which, as we know, are flying through the roof. And so I'm wondering, what are your clients saying?
Sure. Cryptocurrencies and NFTs have been very much part of our discussion with our clients for the last several years. And we very much believe in the digital asset ecosystem and the growth of the digital asset ecosystem. Where we are focusing our clients is really on the underlying infrastructure. So the picks and shovels that's really going to help the technology and the backbone of that digital asset ecosystem. From an NFT perspective, there's a lot of clients that want to understand. They want to understand, like, what are they, but also how do you have value? How do you derive value? So, for example, at the summit that you just mentioned, we had a session on NFTs and physical art versus digital art, and it was a very spirited conversation. But I say a little bit of the bottom line was that investors or clients are looking at NFTs from an investment perspective versus from an aesthetic perspective. And when you look at NFTs from an investment perspective, how do you value them? And if you want to think about art from that perspective, it's very hard to know which companies or tokens are going to be the blue chips. And so if you don't know who's going to be the blue chips, it's best to be prudent, but in terms of sizing of it, but also to look at things like community followership and what type of access do these tokens give you that would increase their value.
So do your clients feel as low on equities as our poll suggests?
So I would say we at Goldman, and I think it's pretty much shared by our client base, we don't think that there's going to be a recession this year. We do think that the probability of a recession has increased in 2023. Equities, if you look at 2019 to 2021, the S&P was up 100%. We think that equities are going to be relatively flat from here. So we're actually at 4,700 on the S&P, so up marginally. And that's pretty consistent with what you saw in terms of what others are expecting. So we wouldn't confuse moderate upside, and even if you've got a muted environment, with a bear market. And there's real tax consequences from selling equities where you're sitting on a real big gain. And so you have to, for us, it's really, how do you think about being thoughtful about offsetting gains and losses as well as just overall structuring? But then also, how do you put incremental capital to work and focusing on equities that are probably going to, more value versus growth?
So we only have about a minute left here. Meena, in the next year, and I should say you took this role right in the heat of a global pandemic, right as it started. What is your goal for the next year?
Our goal is to help our clients maximize their investment portfolios and make it as easy as possible to enjoy their wealth and have the most impact as possible with their wealth.